Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. All right, good afternoon, everyone. Thank you for joining in on my Tuesday session on real estate and taxes. Today, we're going to be talking about how does corporate taxes in Canada work. Before we get into the corporate taxes and how it works, let's learn about the tax rates. So let's assume you are an independent contractor who's working and making $150,000. After your total expenses of $50,000, you'll be left with $100,000, for which you will be paying taxes of 12.2%. That means $12,200. After the taxes, you'll be left with $87,800 after tax in the corporate tax balance. Whenever you are working under a corporation, there is first layer of tax which is inside the corporation, but when you withdraw money, you are getting taxed a second time, which is as part of salary or dividend taxes. So there's two ways to withdraw money from a corporation, either through a salary or through a dividend. If you were to take a dividend out, then you would be taxed at $41,920 and you would be left with only $45,000 in the hand, 50% of the amount that you started off with. Instead of $100,000, you're left with only $45,000. Now let's look at the second option. The second option is paying yourself a salary. In this scenario, you'll be paying $22,405 in taxes when you withdraw $87,800 to yourself as a salary. That means your after-tax cash left would only be $63,000. You must be wondering, well, not only did I pay taxes personally, I'm also paying taxes on the corporation. Then what was the point of incorporating? Well, the Canadian tax system is designed in a way that whether you're in corporation or personal, your effective tax rate should technically work out to the same number. So it is done deliberately. So now you must be wondering, then why should I even incorporate? Well, the answer is because of the tax deferral system, the lifetime capital gains exemption, as well as the limited liability protection. The tax deferral system basically allows you to keep most of the money in the corporation without paying the second layer of taxes. So incorporation only helps if you are earning more than what you need to spend. The second example is, let's assume you wanted to retire. Now, if once I retired 20 years later, I can sell the corporation. If I started at $0 and now I'm selling it for $1 million, that means I will be paying taxes on my capital gains of $1 million. But if I run it under a corporation, I can sell the corporation to the new buyer and be protected against $1 million worth of capital gains exemption. If I made $2 million, then the first million will be exempt and the last million would be paid. And I'll be paying taxes based on my personal tax rate and the capital gains tax rate at that time. The third advantage of incorporating is limited liability. Well, most of the time, people don't understand that if you're running a business under your personal name, and if there was someone to sue you, well, then your personal assets will also be dragged into the lawsuit. And that is what I mean, that there's a limited liability and anything in your corporation will be up for litigation and not your personal assets. So now that we understand how the tax rates work in Canada for a corporation, one of the biggest pitfalls that I'm noticing that most people don't pay attention to is the designation of the corporation. Once you're paying 12.2%, you're technically designated as a small business corporation. But if you are not following the right rules, then you could be subject to a higher tax rate. Instead of 12.2%, up to $500,000, you'll be taxed at 28% or 33% if you're classified as personal services business. Now you must be wondering, how do I avoid falling into this pitfall of becoming a personal services business unintentionally? Well, you have to make sure you create a website. You have to make sure you have diversification of clients. So make sure that you set yourself up in the right way. You have the right legal contracts in place to protect you as well as your customers. Otherwise, you could be facing a very high tax bill of 33%. Moving forward, we have understood how to protect ourselves from personal services business pitfall. Now you should be looking at what are some of the typical expenses you should be claiming. I have a laundry list of 22 expenses that I have listed here, but there's a lot more. So make sure to pay attention and keep an eye out on all of these expenses. Otherwise, you could be in a problem. So in conclusion, How do corporate taxes work? I've already explained to you, but I also want you to understand the deadlines and due dates. First and foremost, if you're operating as a corporate tax individual, you need to keep in mind there's three different tax deadlines. First is for payroll taxes, which is every 15th of the month. The second is corporate taxes, which is 6 months after the year end. And the third is HST, which is 3 months after your year end. CRA also likes to get installment payments. If any of these accounts are more than $3,000, instead of waiting till the year to pay them, pay quarterly. Otherwise, you would be paying installment interest, which could be very significant. And if you're still confused, reach out to us. We'll be more than happy to do a pre-consult and actually set you up for success. Thank you very much and see you next week on a brand new topic. Take care.